Silver hits $59.65. Bank of America, $65 target. The supply is finally gone. For the first time in this market cycle, spot silver has breached the critical $59 level, trading at $59.65 as of this morning's session. This price action coincides with a new research note from Bank of America's Global Commodity Desk, which has officially maintained its near-term price target of $65 per ounce, citing what they term structural inventory depletion. This development has caught the attention of market analysts, historians, and commodity researchers alike. It represents a potential breakout above the inflation-adjusted volatility bands of previous cycles. But is this a temporary anomaly or the culmination of a long-term structural pattern? In this video, I'm documenting a pattern that is repeated across multiple commodity shortage cycles in history. We will examine the data, the historical precedents, and the mechanics of what analysts call the inventory stress cycle. Commodity historians and market analysts have documented a recurring sequence that appears across multiple supply-demand crises throughout history. I call this the inventory stress cycle, not as a prediction tool, but as an analytical framework for understanding how markets have historically responded to extreme supply stress. It's important to note, markets can behave irrationally, timelines vary dramatically, and past patterns don't guarantee future outcomes. History doesn't repeat exactly, but as Mark Twain allegedly said, it often rhymes. Here's how analysts break down the pattern. Stage 1 is the silent drawdown. During this phase, prices often remain stagnant or suppressed, but physical inventories in registered vaults like the LME or COMEX begin to decline steadily. The market is consuming more than it produces, but legacy stockpiles buffer the price, hiding the deficit from the public eye. Stage 2 is visible tightness, or backwardation. This occurs when the spot price rises above the futures price. This is a critical market signal that industry desperately needs the metal now. Lease rates for borrowing the metal begin to spike as availability tightens. Stage 3 is price discovery. This is the stage where legacy inventories reach critical lows, often defined as below 20 to 30% of registered capacity. Price volatility expands rapidly as the market attempts to find the price high enough to destroy demand or incentivize new supply. Stage 4 is re-equilibration. The high prices eventually do their work. Industrial users find substitutes, recycling increases, or new mines come online. The market stabilizes, often at a new, higher baseline. Now I'm going to walk you through two documented historical cases where this pattern emerged: palladium in 2019 and silver in 1980. Then we'll examine the current $59.65 silver price through this dual analytical lens. Case Study 1. The palladium structural deficit of 2018 to 2020. To understand what analysts suggest might be happening in silver today, specifically the industrial argument Bank of America is making, we must look at the most recent clear example of an industrial inventory squeeze: palladium. According to historical data from Johnson Matthey and Bloomberg, here's how the situation developed. For years, the supply of palladium, primarily from Russia and South Africa, fell short of demand from the auto industry, which used the metal for catalytic converters. According to Nornickel reports from the era, the market was in a structural deficit. However, prices remained relatively range-bound because above-ground stockpiles were being quietly drained to fill the gap. By late 2018, the stockpiles reached critical levels. The market flipped into backwardation. Users were willing to pay a massive premium to get metal immediately rather than wait for delivery. On December 12, 2018, Reuters reported that palladium lease rates, the cost to borrow the metal, spiked to over 20%, a clear signal of physical shortage. With vaults draining, the price disconnected from its historical tether. Palladium surged from roughly $1,000 in 2018 to nearly $2,800 by early 2020. A report by Standard Chartered in 2019 noted that consumer buying remained resilient despite record prices. proving that industrial demand can be incredibly inelastic when the commodity is essential for production. Automakers simply paid the price because they couldn't sell cars without the metal. Those holding physical palladium experienced a nearly 180% appreciation during the crisis window. This historical case demonstrates how industrial necessity drives price discovery when inventories hit zero. It wasn't speculation, it was pure manufacturing necessity. Case Study 2. The 1980 Silver Spike. While palladium was an industrial squeeze, silver in 1980 was a monetary and speculative squeeze. Comparing these two helps us understand the dual nature of silver today. According to Federal Reserve Archives and CFTC historical records, the Hunt brothers, fearing inflation and currency debasement, began accumulating vast amounts of physical silver. During this period, global inflation was rampant, hitting 13.3% in 1979. As the Hunts and their partners accelerated buying, they began taking delivery of futures contracts, removing metal from COMEX warehouses. According to the Fay report commissioned by the exchanges, the group controlled over 100 million ounces of silver positions. In January 1980, the price went vertical, moving from $6 to nearly $50 in a matter of months. On January 17, 1980, silver hit its intraday high of $50.35. The panic wasn't just about supply, it was about the loss of faith in the U.S. dollar. The resolution in 1980 was not natural market reequilibration, it was regulatory intervention. The COMEX changed the rules, implementing liquidation-only trading orders and raising margin requirements. This forced the Hunts to sell, collapsing the price. When we compare the 2019 palladium squeeze and the 1980 silver squeeze, several similarities emerge. Both experienced backwardation in Stage 2. Both saw inventory levels drop significantly before the price explosion. However, there were key distinctions. Palladium was driven by industrial need, while 1980 silver was driven by investment demand and leverage. Before we examine the current $59.65 price level, it's important to consider opposing perspectives. Not all analysts agree that we are in a structural supply crisis. Some analysts argue that higher prices will immediately unlock vast amounts of hidden silver. For example, Metals Focus has published research suggesting that as silver crosses $50, jewelry and silverware melting tends to increase dramatically. While true historically, data from the Silver Institute indicates that recent deficits have been so large that even a 20% increase in recycling may not cover the industrial gap. However, it is a variable that could cap prices. Other economists point out that high prices cure high prices. Bloomberg NEF notes that solar manufacturers are actively trying to reduce the amount of silver paste in photovoltaic cells. While thrifting is real, new technologies like TOPCon solar cells actually require more silver per unit, not less, potentially offsetting these efficiency gains. Traditional market theory also suggests that the paper market, futures and derivatives, can absorb demand without needing physical metal. This view holds that price is set by futures flows, not physical delivery. However, historical precedent documents instances like palladium, where the physical reality eventually overrides the paper derivative pricing. Now let's examine recent data to see if similar conditions to our historical cases are present today with silver trading at $59.65. Looking at Stage 1 indicators, inventory. Current data from the CME Group shows COMEX-registered silver inventories have declined significantly from their 2021 highs. As of the latest report, registered stocks are hovering near multi-year lows. London vaults, which back major ETFs, have seen consistent outflows documented by the Silver Institute. Analysts comparing this to the palladium case study note that the silent drawdown appears to have been in effect since late 2020. Looking at Stage 2 indicators, tightness. According to the Bank of America research note released this week, industrial demand from the green energy transition has created a structural deficit. The note specifically targets $65 as the next resistance level, driven by what they call inflexible industrial offtake. Some researchers interpret this as the transition from an investment market to an industrial market, meaning companies like Samsung or Tesla may need to secure metal regardless of price. Looking at Stage 3 indicators, price discovery. Recent market behavior confirms Stage 3 characteristics. The breach of $50 and the move to $59.65 suggests the psychological ceiling has broken. Volatility has expanded, with daily ranges widening significantly. When mapping current conditions to our historical framework, inventory drawdowns align with Stage 1, and the Bank of America target aligns with Stage 3 price discovery. However, we have not yet seen the extreme lease rates present in the palladium example, which remains an ambiguous signal. Analysts examining historical supply-demand dislocations have modeled several potential scenarios for the weeks and months ahead. It is crucial to understand these are possibilities based on past precedent, not guaranteed predictions. Scenario A is the palladium continuation. If conditions develop similarly to the 2019 palladium squeeze, industrial users may panic buy to secure inventory. Prices could disconnect further from production costs, potentially exceeding the Bank of America's $65 target. Scenario B is the 1980 regulatory cap. Alternatively, intervention could occur. Exchanges could raise margin requirements to dampen volatility, or governments could impose price controls. In this scenario, price spikes are often followed by sharp, rapid corrections. Scenario C is the demand destruction plateau. Prices could stabilize near current levels. At this price point, new mining projects become viable, or manufacturers successfully swap to copper, leading to a high-price equilibrium rather than a parabolic spike. For those studying commodity supply-demand dynamics, here is how professional analysts typically structure their research. Before I walk you through this framework, let me be clear once more. This video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. Analysts tracking supply stress typically examine the COMEX Daily Warehouse Report to look for registered category changes. They also watch the Commitment of Traders report released Fridays by the CFTC to see if banks are short or long. Researchers focused on demand examine solar PV installation data from the International Energy Agency and global semiconductor sales as a proxy for industrial silver demand. This framework is for educational research only. No one can predict market outcomes with certainty. My role is documenting patterns and presenting analysis, not advising individual financial actions. We have examined the documented historical pattern of the inventory stress cycle. We've compared the current $59.65 price breakout and Bank of America's $65 target against the backdrop of the 1980 and 2019 case studies. Key analytical findings are that current inventory drawdowns mirror Stage 1 of our historical framework, and industrial demand is playing a larger role than in 1980, making the palladium comparison highly relevant. However, regulatory intervention or demand destruction remains significant variables that could alter this trajectory. I create this content to document patterns, analyze data, and facilitate informed discussion, not to provide financial advice or predict the future. If you found this analysis valuable, consider conducting your own research using the CME and Silver Institute sources mentioned. What is your perspective? Do you see this as a repeat of the 1980 speculation or a structural industrial shift like palladium? Let me know in the comments. I read and learn from every thoughtful response. Thank you for engaging with historical pattern analysis. Until next time, stay curious and stay informed.